Skyler Weinand is CIO at Regan Capital. Let's start you off with the bubble question. Does this feel like a bubble to you?
It sure does. With stocks back to all-time highs, short end rates up 500 basis points in the last 2 years, long end rates up 250 basis points. You do the math on where stocks should be, given that rise in rates, stocks theoretically should be down upwards of 40% over the last 2 years.
Wow.
So we're
I
at it.
know.
You just took Bailey's breath
Yeah,
away.
no. So what breaks then, Skyler? I'm just looking, we've got the swaps pricing in just under 6 rate cuts next year or this year. We've got a lot of analysts and strategists talking up 2024 earnings and looking into 2025. What happens?
You have to look at leverage first, and the most levered players out there are going to break first. We've already seen that in banks. Then it goes to private equity and very leveraged companies. The last folks to lose will be the least levered companies that are using a half a turn or maybe over only a turn of leverage. So I think the market's going to be really bifurcated. You hear a lot of folks talk about, let's stick to high quality. I like that. But look to leverage to break before anything else.
All right, 2 questions then off that, Skyler. Going back to your initial point, are you shorting the market, and then are you shorting some of these levered stocks? How are you playing that?
I think, we're not stock guys, but in my stock investments, I think, it's one of 2 things. A, sometimes the only way to win is not to play and to wait it out and maybe stick in mid to high single digit income plays. But B, own the entire market as well, where I don't know when the next NVIDIA or Tesla or Monster Beverage is going to come along. So I want to own them all.
Who's most over leveraged? Is that the right phraseology?
Definitely banks. Banks are government-sponsored hedge funds, so to speak, allowed up to 12x leverage. Now, what's happened over the last 2
You're
years,
talking the majors or regionals or what? Or just the entire
all banks
industry?
are allowed the same leverage, but regionals and community banks got a ton of cash in post-COVID, post-PPP, right? So folks got all this cash, they parked it at the banks. Banks sat there for 8 months. What are we going to do? Okay, let's go out and start buying treasuries and mortgage bonds. What's happened is
Which was a
a lot of those
disaster.
bonds are down upwards of 20 points, right? And so if you were levering that up 10 times, 12 times, your effective equity now went from 10% down to about 4%. So you're upwards of 25x leveraged. So what you have to look at is you have to look at tangible book value, tangible equity, right? And if that percentage is at only 4 or 5%, divide 4 into 100, that's 25x. So you're 25x levered. So moves like we've seen since the start of the year, the bond market's down a point and a quarter. Multiply that times 20 for a regional bank or a community bank that owns treasuries and mortgage bonds.
So who's least leveraged then on the opposite end of the spectrum?
JP Morgan, the big guys who had a lot of money, they took it in, they focused on fee-paying product like credit cards. They weren't immediately incentivized to go out and buy really, really long duration paper. And so on the flip side of the large guys, B of A, you'll see, has huge amounts of unrealized losses sitting on their balance sheet. JP Morgan looks like a genius because they didn't really go and invest in all of that money into Fannie 2.5 coupon paying mortgages, which 2 years ago, the market thought everybody was going to refinance. And something like 70% of all mortgages have been issued in the last 2 years. So now the market thinks nobody's ever going to refinance again. Nobody's ever going to move. Everybody's stuck in these 2.5% coupon mortgages. So it's who owns that stuff and who doesn't. And JP Morgan stuck really short duration. And now they're coming out ahead of everybody. The time to own money markets and T-bills, honestly, was when rates were 0. not when rates are at 5.25, 5.5.
Well, Skyler, we've talked a lot about what you don't like. What do you like?
So now there's two sides of the coin in terms of equities and in terms of real estate and most things. It's, do you want to be the equity holder or the lender? Now is a great time to be a lender, okay? And you can be a lender on real estate. You can be a lender to equities, i.e. bonds. You can be a lender to municipalities. So now is as good of a time as ever to lend. The market's been hoping, savers have been waiting for 5+% yields on high quality fixed income for what, 16 years now? And it's here. We should be jumping into this like Scrooge McDuck.
Okay, I've always been told you don't fight the Fed, but certainly the bond market has been fighting the Fed, or so it would seem. Your impression, got about a minute left.
Yeah, the market, the Fed has been saying for the last 2 years now,
but we haven't been listening.
There's going to be a lot of pain, right? And we've seen pain. Bond market was down 13% last year, came back the last 2 months of, or I'm sorry, 2022, came back the last 2 months of 2023 to make it a positive year. And the Fed is still saying rates are only going to drop 2 to 3 times this year. Yet the market has priced in 6 drops this year and 8 drops over the next 18 months. So it's a really good time to sit in floating rate paper that'll hugely benefit from the Fed, what's the Fed saying happening versus what the market is saying. If you're in fixed rate paper right now, what you're along is rates dropping 7, 8, 9 times over the next 18 months.
All right. We'll leave it there. Skyler Weinand, the CIO at Regan Capital. Words of warning.
Yeah.
You were like taking a
I was caught off guard by it, to say the least.
You were also caught off guard by the snowstorm.